Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Baiya International Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month.
Yeah, it's a really solid setup if you're looking for that kind of structure.
Right. If you're trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice.
Exactly. You always have to protect your downside.
It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, so I want you to imagine something for a second. Imagine you own a really boring, low-margin, brick-and-mortar temp agency.
Okay.
You specialize in traditional, flexible employment, labor dispatching in the Chinese market. It's highly fragmented, it's insanely competitive, and you are actively losing money.
Which is a terrible place to be, obviously.
Right, exactly. So what do? I mean, most management teams would try to cut costs, lay off middle management, or maybe slowly try to modernize their software over a few years. But the management at Baiya International Group, they decided on a slightly different path.
To put it mildly.
Yeah, they decided to completely rewrite their corporate identity overnight.
Oh.
They went out and bought $1 million in cryptocurrency and basically tried to turn their stock into a high-speed vehicle for Web3 traders.
Yeah, the Binance plan, as they're calling it.
Exactly. They have officially branded this massive corporate pivot as the Binance plan. And today, we are unpacking exactly what that actually means for you if you're looking at this market.
Because it forces you to do a double take, without question. And, the market's reaction has just been absolutely explosive. We're looking at a stock that just surged over 84%.
Yeah.
Hitting $1.14.
Yeah.
And if you actually pull up the intraday data, there was a point in the session where this saw a massive 102% spike.
Which is just staggering.
It really is. It's the exact definition of a momentum eruption. But what makes this so fascinating to me is the underlying psychology behind the move.
Yeah.
They're stepping out of a sector that literally nobody pays attention to.
Traditional staffing.
Right, traditional boring staffing. And they're directly associating themselves with the highest growth, highest momentum narrative available right now.
It completely hijacks both retail and algorithmic attention. Because, think about it. If you walk into a place that helps people find temporary warehouse jobs, and the manager suddenly announces they are ripping out the filing cabinets to install Bitcoin mining rigs.
Right. You'd think they were crazy.
It feels completely out of left field. It is totally jarring. But it immediately gets you talking, which is exactly what a microcap needs to survive.
It creates visibility, which leads us directly into how this fits into a broader strategy for your portfolio.
All right, let's move into the wealth building context.
When you evaluate a massive structural pivot like this, you really have to understand the concept of a proxy play.
Yeah, that's crucial.
So this company just established a $1 million strategic position in BNB, which is Binance Coin. And the strategy here, it heavily mirrors the famous playbook used by companies like MicroStrategy.
Right, Michael Saylor's whole approach.
Yeah, exactly. The goal is to establish a structural bridge. By holding BNB on their corporate balance sheet, Baiya offers traditional stock investors a way to gain exposure to the Binance ecosystem without having to navigate, digital wallets or private keys or actual crypto exchanges.
Which a lot of traditional investors still don't want to touch.
Right. So if the crypto market goes on a massive run, Baiya's overall book value and asset base increase organically. They're essentially building a crypto treasury moat to differentiate themselves entirely from any traditional service peers.
Okay, but...
And they get to grow their asset base without diluting their shares to fund those old legacy operations.
I hear you. I hear the comparison to MicroStrategy. But if you are listening to this right now and wondering, why not just buy Binance Coin directly instead of buying this microcap stock? That is the exact right question to ask.
That's a fair question, sure.
Because I have to push back on this idea of foundational wealth building in this specific scenario. MicroStrategy is a massive enterprise, right? BIYA is a microcap. You have to ask yourself, is a microcap acting as a proxy vehicle for crypto a true fundamental wealth builder for your portfolio, or is it just a high beta trade for the crypto bull run?
Well, beta just refers to volatility, right?
Exactly. And by high beta, I mean a stock that acts like a magnifying glass for that volatility. If Binance coin twitches up 2%, this stock violently swings up 10%, but it crashes just as hard on the way down. Proxy plays tether your equity value directly to the volatility of a digital asset.
Yeah, that is a completely fair caution. But the counter-argument, and the reason you see these insane run-ups, is that traditional equity markets often assign a heavy premium to pure crypto assets once they are wrapped in a corporate, publicly traded structure.
Because of the accessibility.
Right. For a massive segment of institutional and retail capital that is legally or mandate restricted from buying crypto directly, that structural bridge is highly, highly valuable.
I get that. But a moat only protects a castle if the castle itself isn't crumbling underneath.
Let's get into that.
Now let's look at the fundamentals. Because beneath this flashy new crypto treasury narrative, there is supposedly an actual functioning business operating here.
Right, and management is currently undergoing a massive internal overhaul.
Yeah.
They're basically cleaning house. They are actively slashing their legacy labor dispatching services.
Which they have to do.
Oh, absolutely. From a fundamental accounting perspective, this makes perfect sense because those historical operations were yielding negative gross profits.
Meaning they lost money on every single transaction.
Exactly. They were actively bleeding cash just by keeping the doors open. So going forward, they are staking their entire operational future on a proprietary SaaS platform known as the William platform.
Okay, and what exactly does that do?
It's a high-margin technology play that uses big data and artificial intelligence for human resources management.
All right, let's break down how that AI actually functions in this real-world context. Because everyone slaps AI on their pitch deck these days.
True. But the fundamental thesis here is that AI can optimize the highly inefficient labor market. So instead of human dispatchers calling 50 different people to try and fill a single warehouse shift, the platform uses predictive matching algorithms.
So it's instantly pairing them up.
Right. It instantly connects flexible workers with enterprise needs, drastically reducing the overhead costs of human resources.
Which makes sense conceptually.
And if management can successfully combine the high-margin revenue from this AI-driven tech with the non-dilutive asset gains from their Web3 crypto pivot,
Yeah.
they completely transform your balance sheet.
Okay, that sounds phenomenal in theory. But I really need to bring up a staggering fundamental detail that completely alters the reality of this operation.
The reverse split.
Well, yes, to maintain their NASDAQ Q compliance and keep the share price above the minimum listing requirements, they recently executed a 1-for-25 reverse share consolidation, which is huge. We will dig into the dangers of that later. But setting the reverse split aside for a second, here's the bombshell.
Okay, lay it on us.
This company has exactly 5 employees.
Yeah. It is undeniably a lean operation.
Lean doesn't even begin to cover it. I really want you to visualize the logistics of this. You can hold $1 million of cryptocurrency with a lean team. Sure, it's just a digital wallet.
Right.
But you cannot run an international publicly traded company, maintain strict NASDAQ compliance, file quarterly financial reports, build an AI-driven human resources platform, and execute a highly volatile Web3 strategy with a team small enough to fit inside a single minivan.
Wow.
The math on their human capital simply does not add up to the sheer volume of their corporate ambitions.
Look, I see the skepticism, and it's valid.
Yeah.
But you have to remember that the very nature of a modern crypto treasury and an AI SaaS platform is inherently asset light.
Even with 5 people.
Yes, because the entire point of algorithmic human resources is that you do not need an army of middle managers. The legacy business.
Labor dispatching.
Right, the labor dispatching that actually required heavy human capital and physical offices. That is exactly what they are slashing.
Okay, I see what you're saying.
They are actively shrinking the labor-intensive anchor around their neck to focus exclusively on scalable digital infrastructure, which means we need to look at what's next on the horizon to prove if this model actually works.
That brings us to the catalyst timeline.
The single most critical upcoming catalyst is their next earnings report. The market has obviously digested the press release about the $1 million BNB position.
The price action shows that.
Yeah. But institutional investors need to see the exact accounting treatment of that asset on the actual balance sheet. Furthermore, Baiya just announced a definitive agreement to acquire a Dubai-based tech firm called Starfish Technology.
Which is a very interesting move.
Very. And the market is waiting on pins and needles to see exactly how Starfish's assets, specifically something called UpT, are going to integrate into Baiya's daily operations.
And we should probably explain what UpT and this integration actually represent for the listener.
So UpT appears to be tied to the tokenization of their ecosystem.
Tokenizing HR data.
Yes. When a company talks about tokenizing an HR platform, they're talking about taking traditional labor data, like a worker's verified shifts, their reliability score, or even their payroll, and converting it into secure, immutable digital tokens on a blockchain.
Okay, so creating a verified digital identity for temporary workers.
Exactly. And the speculation is that the Starfish acquisition provides the actual underlying Web3 plumbing to make this happen.
And choosing Dubai as the geographic hub for this tech acquisition is definitely not a coincidence.
Oh, not at all.
Dubai is aggressively positioning itself as the global capital for Web3 regulatory clarity and development.
Right, and that is the core of the growth thesis here. Buying Starfish technology brings vital geographic diversification, but more importantly, it buys the actual technological infrastructure.
To prove it's not just a bluff.
Exactly. It sends a message to the market that the Binance plan isn't just an empty corporate buzzword they threw on a press release. They're acquiring the tech and the talent to execute it.
Assuming the 5 employees can manage it.
Fair enough. But you also cannot ignore the massive macro catalyst floating above all of this, which is the broader crypto bull market.
Oh, 100%.
Every single time Bitcoin or Binance coin makes a violent move to the upside, it acts as a continuous ambient catalyst, basically dragging Baiya's stock up with it.
All right, well, now let's pivot to the chart, because the technicals here are telling a story of pure, unadulterated market force.
Yeah, the recent price action is a violent textbook breakout. We saw a long, quiet, prior consolidation phase where nothing was really happening, followed by an absolute explosion upward.
A total vertical move.
Right. But you cannot just look at the price candles. You really have to look at the volume bars at the bottom of the screen. We saw 88.85 million shares exchange in a single trading session.
Okay, we need to do a reality check on what that volume actually means, mechanically speaking, for you as a trader. Let's talk about float turnover.
Go for it.
The float is the actual number of shares available for the public to trade, excluding what insiders hold, right? So when a company executes a 1-for-25 reverse split like Baiya did, their share float shrinks dramatically.
They literally compressed 25 shares into one.
Exactly. So when you see almost 89 million shares traded in a single day on a microcap with a tiny post-split float, it means every single available share changed hands multiple times in a matter of hours.
It is an unbelievable influx of capital. It signals a complete overnight sentiment reversal.
It's chaotic.
It is. When you see volume of that magnitude on a highly constrained float, you are usually looking at a massive short squeeze. People betting against the stock are forced to buy back in to cover their losses, and that's combined with heavy algorithmic accumulation stepping in all at once.
Honestly, I would argue it is pure, chaotic retail momentum trading. Think of it like a massive game of musical chairs for day traders.
Yeah, that's a good way to put it.
When the entire float turns over that many times in one session, the trading activity becomes completely disconnected from any underlying business metrics.
They aren't trading the fundamentals?
Not at all. At that precise moment, nobody is trading the fundamental value of the AI platform or the long-term vision of the Dubai acquisition. They are just trading the tape.
Right, buying the momentum.
They are buying it because it is going up, and it is going up because they are buying it. It is highly lucrative if you catch the wave, but you have to recognize it for what it is, purely technical momentum.
So what does market sentiment look like?
Well, based on that exact momentum we just talked about, the mood has shifted entirely, 100% to the bullish side.
No surprise there.
Right. The stock has been aggressively flagged across pre-market, intraday, and aftermarket mover lists on every major financial platform you can look at.
And the quantitative algorithmic sentiment is really fascinating to dissect here. Because of this massive volume and price action, automated news screeners are pulling Baiya's ticker and grouping it in daily wrap-up stories.
Oh yeah, I saw that.
They are grouping them alongside major established market movers like Estee Lauder.
Which is crazy when you think about it.
It is. If you are a retail trader scanning for the day's biggest winners, you see a tiny microcap listed right next to a global cosmetics giant. This drives even more algorithmic and retail eyeballs to the stock, which creates a self-fulfilling loop of visibility.
But the most crucial sentiment driver, by far, is that $1 million corporate treasury allocation into BNB.
Absolutely.
But wait, let's step back. How does a $1 million treasury trigger retail traders so aggressively? In the grand scheme of the public markets, $1 million is absolute pennies.
It is pennies for a large corporation like Apple, yes. But for a microcap company, putting $1 million of real cash on the line is viewed by retail traders as the ultimate insider buy signal.
Because it's a huge chunk of their actual liquidity.
Exactly. Management isn't just releasing a fluffy press release saying they conceptually support Web3. They are taking the company's actual cash and putting it at risk.
It proves they have skin in the game.
It proves they are genuinely aligning themselves with the Binance ecosystem.
And, the naming convention of that ecosystem alignment also plays a massive psychological role here. Calling your official corporate strategy the Binance Plan is an incredibly bold, highly calculated choice.
It is completely intentional.
Yeah, they didn't just call it a Web3 pivot.
No.
Yeah.
Naming your entire strategic pivot directly after the world's largest, most influential crypto exchange heavily implies a hope for deeper incubation down the road.
Like an official partnership.
Right. Whether a direct partnership actually exists or whether it is just a distant corporate aspiration, retail traders are eagerly, aggressively pricing in the possibility that this tiny company becomes officially tied to the Binance juggernaut.
Okay, well, now let's talk about the risks. Because in a setup with this much explosive retail-driven hype, the bear case is just as important, if not more important, than the bull case.
You have to know the downside.
Always. We have some massive elephants in the room here, and if you are listening to this and considering a trade, you absolutely need to understand the mechanics of the trap.
So the first major risk is structural. We touched on the 1-for-25 reverse split they executed late last year.
Yes, and I need to be perfectly clear about how this mechanism works. Historically speaking, for you as an investor, a reverse split is a screaming red flag.
Almost always.
Companies do not voluntarily compress their share count because their business is thriving. It is almost exclusively a defensive maneuver to mask underlying financial distress and artificially inflate the share price just enough to avoid being delisted from the Nasdaq exchange.
The historical precedent for reverse splits is definitely grim. It's usually a warning sign.
But the pattern that usually follows is what creates the real danger, which we call the dilution trap. Here is how it works. Pay attention to this.
Walk us through it.
Step 1. The microcap company executes the reverse split to artificially prop up the price. Step 2. They issue a hyped-up news narrative, like, say, a massive pivot to a Web3 crypto treasury.
Sounds familiar.
Step 3. Retail traders flood in, driving the volume up to 88 million shares and violently spiking the price.
And then step 4.
Step 4. The company, which desperately needs cash, uses that retail momentum as exit liquidity. They issue millions of brand new shares directly into that buying frenzy to raise capital for themselves.
Diluting everyone who just bought in.
Exactly. So while the Binance Plan narrative sounds incredibly modern and exciting, you have to be highly cautious. Buying into massive momentum spikes immediately following a reverse split often ends in painful, portfolio-crushing share dilution for the retail traders left holding the bag.
It's a very real threat. And the second major risk circles back to your earlier point about the human capital. Rebranding your corporate identity and buying some cryptocurrency on an exchange is the easy part.
Anyone can do that.
Right. The hard part is the sheer execution risk. They are relying on a 5-person team to actively manage a highly volatile digital treasury while simultaneously attempting to integrate a foreign tech acquisition from Dubai.
Which is complex on its own.
All while building and maintaining a complex AI human resources platform. If any one of those 3 pillars wobbles, the entire narrative collapses.
The margin for operational error is essentially zero.
So with everything on the table, what's the final verdict?
Well, based on the research and the current market dynamics, the bullish score sits at a 7 out of 10.
Which is pretty strong.
It is. There is undeniably high conviction on the short-term momentum and the sheer power of this dramatic narrative shift. The market clearly loves a crypto proxy play, and the volume proves the demand is real.
Yeah, the buyers are there.
However, that high score is heavily tempered by the severe microcap execution risks and the looming mechanical threat of share dilution.
Which entirely dictates the timeline and the strategy for how you should actually approach this.
Exactly.
If you look at the long-term view, this is currently structured as a swing trade, meaning a position you monitor for a 1 to 3 month horizon rather than a multi-year buy and hold foundation for a retirement portfolio.
You are not holding this for 10 years.
No. The strategy here is to capitalize on the current undeniable momentum surge as we head into the next earnings report. That upcoming report is the absolute make-or-break moment.
Because the numbers have to back up the story?
Exactly. That is when the actual balance sheet impact of the BNB position and the real cost of the Dubai acquisition will finally be revealed to the public.
It all comes back to that temp agency analogy. Right now, the market is cheering wildly because the manager bought the mining rigs and painted Web3 on the front door.
Right.
But over the next quarter, we're going to find out if they actually know how to plug the machines in, or if they are just going to try and sell you their shares to pay for the electricity bill.
It is a fascinating high-stakes transition to watch unfold, that's for sure.
It really is. Now, if you want to build a cleaner trading workflow, you can check out VIP Algos at the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access.
A lot of great tools in there.
Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.